Hi traders, you're welcome back to the Forex Geek channel. Now in this video, we're just going to be diving into one of the most effective trend trading strategies, and that is the multiple moving average strategy. Okay, if you have ever struggled with identifying trend direction, spotting reversals, or filtering out market noise, then this strategy is going to change the way you trade. Okay, by the end of this video, you'll learn why multiple moving averages are better than a single one, how to set up this strategy on your chart, the best way to use moving average crossovers for entries and exits, and how to avoid common mistakes when using moving averages. So if you're serious about improving your trading, hit that like button and subscribe for more top tier trading content. Okay, let us quickly get started. Now, moving averages are one of the most popular indicators in trading. Okay, moving averages, they are one of the most popular indicators in trading. All right, this approach uses a combination of short-term, medium-term, and long-term moving averages to identify clear trends, which is to know whether the market is bullish or bearish at a glance, and also to catch strong entries and exits. Moving average crossovers act as as trade signals, right? Crossovers is one of the popular strategies that many traders use. And then we also use this to filter out false moves, avoid getting caught in weak price swings. And finally, we use it to confirm momentum shifts, okay, to see when a trend is gaining or losing strength. So by layering multiple moving averages, we get a better understanding of market structure and make more informed trading decisions. All right, now let's just break down the three key moving averages used in this strategy and how they work together. All right, for our short-term moving average, which is the fast moving average, which captures short-term price action and reacts quickly to market movements, we're going to be using the 9 EMA, the 9-period EMA for that. Okay, then for our medium-term moving average, the medium-term moving average acts as a trend filter, helping traders identify whether the price is respecting a trend. We're going to be using the 21 EMA for that. Okay, so I just have to change the color for easy identification. All right, and then for our long-term moving average is the slow EMA, right? It defines overall trend direction and filters out market noise. Okay, so we're going to be using the 50-period moving average, right? We're going to be using the 50-period moving average, 50-period EMA. Now, these moving averages work together to confirm trending conditions and potential trade setups. Okay, now for a bullish setup, the short-term moving average, which is the 9 EMA in this case, crosses the medium-term and the long-term moving averages. All right, so the short-term crosses above both the long-term, the medium-term, and the long-term, right? This signals that momentum is shifting to the upside. So the price stays above all three moving averages, confirming trend strength. Then you can look for a pullback to the medium or to the long-term moving average. Then enter the price when it bounces back up. Okay, you can place your stop loss just below the long-term moving average to protect your trade. Then for a bearish setup, the short-term moving average crosses below the medium-term and the long-term moving averages, signaling bearish momentum. The price stays below all three moving averages, confirming downtrend, right? Confirming a downtrend. Then you wait for a pullback to the medium or to the long-term moving average. Enter when price rejects the level, and then you place your stop loss just above the long-term moving average to minimize risk. So by waiting for clear crossovers and trend confirmations, you increase the probability of strong trade setups while avoiding weak signals at the same time. Now, even though this strategy is quite effective, traders often make critical mistakes that reduce its effectiveness. So here's what to watch out for. The first key point is trading every crossover. Now, it's important for you to note that not every crossover is a strong signal. Okay? So always check for trend confirmation before entering. For example, can we see what happened here? Can we see what happened around here? Um, so now you will notice that we had crossovers within this range, but these signals were not tradable, I would say, because it was so rough. Basically, moving averages are trending indicators, so it's advisable not to use them in ranging markets. So if you want to trade these crossovers now, you might end up getting stopped out, because if you imagine you enter a buy here, and before you know it, it has already crossed down back and all of that. So it's better to always wait for trending markets before entering. Okay, so check for trend confirmation. That is the reason why you must check for trend confirmation and confirm that you have a trending market before you even consider entering the trade. And then do not ignore higher time frames, because a crossover on the 5-minute chart, for example, may not hold on the 1-hour chart. So always check multiple time frames for stronger confirmation. It is very necessary. Okay, and do not trade in ranging markets. I'm going to emphasize that. On no account should you trade in ranging markets, okay, to be on the safer side, because moving averages work best in trending markets. So avoid using them in sideways price action where they provide false signals. Okay, so by avoiding these mistakes, you will improve your accuracy and confidence when using the multiple moving average strategy. And pay attention to risk management as well. Okay, always employ good risk management. Do not trade with an amount you cannot afford to lose, and do not risk more than 1 to 2% of your account balance in a single trade. Okay, and always observe good risk to reward ratio. For example, let's say we are going to take a sell trade after we got this crossover. You can see this was a sell trend. Yes, because take sell trades in a sell trend and take buy trades in a buy trend. So let's say we are going to enter a sell, and then we set our stop loss above the previous swing high, right? And maybe we had entered right after this pullback. So this probably would have been our entry point. So in this case, we will be risking about 1,200 points. So our profit target should be at least 2,400, right? But remember, before you enter that trade, or do this calculation already, okay? Yes, so that if you don't have a good risk to reward ratio, you can just stay out. So once you have already identified, you have done your calculation, this is your potential stop loss and this is your potential profit target, and you will see that your stop loss level is about 1,200 points. This is about 2,600. So we have about 1 to 2 risk to reward ratio. So in that case, you can go ahead and enter your sell, set your stop loss, set your take profit. All right, so that is it, traders. Now you know how to use multiple moving averages to identify trends, time your entries, and avoid false signals. If you found this video helpful, hit that like button and subscribe for more powerful trading strategies. Comment below, do you use multiple moving averages in your trading? What is your favorite setup? Let us discuss. Okay, thank you for watching, and I hope to see you in the next video. Happy trading.